Apple remains the place to look. So 3 downgrades in the last 2-3 weeks.
Yes.
Do you remember, prior to this string of downgrades, a few months ago, Apple got downgraded, and we joked on the show, like, okay, that marked the near-term bottom for that one.
Yes.
And then, Apple comes roaring back off of that downgrade. And then it gets these 3 downgrades, and stock's looking dicey. Technically, it's kind of messed up. The last one was Redburn Atlantic downgrading it to neutral. What happens from there? Stock's pushing back towards 200.
Mark the bottom once again. It's remarkable because if you look at the S&P 500 year to date, which I did this morning, 71% of the S&P 500 is underperforming the overall performance year to date for the S&P. And going beyond that, actually 61% of the stocks in the S&P 500 coming into this morning were actually negative on the year. So you take a stock like Apple and you try to insert this negative sentiment towards it in the face of very, very strong fundamentals. And strong fundamentals, not just from the standpoint of earnings, which have been relatively flat, but just the ability to buy back their own stock. And what's interesting about the rally over the last several days is, remember, it's happening at a time we're in a blackout period for corporations to buy back their stock, which is another compelling case. But I think Apple is just a classic example of not trying to push against the overall momentum in the market. And the momentum in the market is incredibly strong. And the momentum in the market is being captured by a lot of non-discretionary funds. And I really want to highlight that because I don't think people understand how the market structure has changed so dramatically to where now you have algorithms, you have quant funds, and you have non-discretionary capital that really is the overwhelming driver of where the market goes. And I think Apple is a clear example of being a beneficiary of that type of non-discretionary momentum.
You could make the argument, Jason, that, the time to be negative Apple was when it was going to head down into the 160s, like the high 160s. Is where it got back to. Now it's rallying back once again, and we have the parade of downgrades in the last couple of weeks. Today, not so much. Bernstein reiterates it as market reform. Bank of America says AI could drive Apple to outperform in 2024. Stronger upgrade cycle coming, driven by the need for the latest hardware to enable generative AI features. So that's their call there.
Yeah, so I think for me, you pointed it out, Scott. 3 downgrades, right? And then you see obviously the price action that we saw.
It's rare that you see 1 downgrade, okay? In the span of a week, or 8 days, from January 2nd to January 10th, you got 3.
100%, and then they lose the position as the largest company in the world, right? And then Microsoft obviously takes the lead, which obviously Microsoft's price action has been strong. But again, I think for me, as it relates to Apple, a couple weeks ago is a source of funds. You get the upgrade, and, there's no longer concern about the multiple 29 times forward. Foxconn is no longer issue supply chains, upgrade cycle. We hear about the glasses, 180,000 pre-orders sold, right? So I think it's just benefiting from the momentum in the tech space as rates pull back.
You got the watch drama. You have some potential regulatory issues, DOJ, all these reports coming out. It's like, okay, the stock doesn't seem to pay much attention to it over the last, several days, looking ahead probably to earnings and figuring that the negative part of the story is troughed. 3 consecutive quarters of negative revenue growth. That's in the rear view. Smartphone market was weak globally. That's going to be troughing as well.
Look, I'm not a big believer in there's a huge catalyst out there to move Apple higher. Okay, I know some people are putting the VisionWear goggles out there as the catalyst. That's fine. You can make a market on anything you want to. I just don't believe that. I think this is more, and I'm going at you, Joe, with this. This is more going to respond to the market overall. If animal spirits return and people are coming back to the market right now, just by definition, those non-discretionary buyers that you're talking about have to go to Apple. If you're anywhere exposed to the S&P 500 or the triple Qs. Now, what I think is interesting here, and I'm going to dovetail to something you said about the algorithms, because I said this to you on the air yesterday in a rhetorical last week, and I didn't quite get an answer. What happens? We were talking about interest rates. You were talking about interest rates a second ago. What happens when the yield curve all of a sudden disinverts? I think those algos, just to answer the question, are now going to pile on, and I think that's going to happen. So I hear you on, hey, we'd like to have the 10-year at 3 3/4, but I don't think so. I think you want to get it higher. Maybe the 2-year comes off a little bit, but when that yield curve uninverts, I think the algos are going to pile on. It's going to benefit Apple. It's going to benefit everybody in the market.